In today's world, almost every country is in debt. The United States, Japan, Britain, China, emerging economies, advanced economies, small nations, large empires, all of them owe money. And if you scroll through financial headlines long enough, you'll see numbers that almost don't make sense anymore. Trillions upon trillions stacked on top of each other like some endless tower of IOUs. But here's the question that nobody really stops to ask. If every country is in debt, who exactly is on the other side of that ledger? Because debt, by definition, means someone is owed something. If governments collectively owe hundreds of trillions of dollars, then logically, someone out there must hold those claims. There must be creditors. There must be balance sheets listing those debts as assets. And yet, the way we talk about national debt makes it sound like the entire world is simply drowning in money owed to no one in particular. That's where things get interesting. When a government goes into debt, it doesn't call up a mysterious global bank and ask for a loan. What it actually does is issue bonds. These bonds are promises, formal contracts that say, lend us money today and we will pay you back later with interest. And those bonds are sold into the financial system. Now here's the crucial part. Those bonds don't disappear into a black hole. They are bought by investors, pension funds, insurance companies, commercial banks, central banks, investment firms, sometimes even other governments. And once they're purchased, those government bonds become assets, something of value, sitting on someone else's books. So the debt that looks like a burden from one perspective is actually wealth from another. If a government owes $1 trillion in bonds, then somewhere in the system, investors collectively own $1 trillion in government assets. What we call debt on one side is called safe investment on the other. And this is where the modern financial system reveals itself. Because government debt isn't just tolerated, it's relied upon. Pension systems depend on it. Banks use it as collateral. Financial institutions treat government bonds as some of the safest instruments in existence. In many ways, sovereign debt is not a flaw in the system, it is a foundation of it. So when headlines scream about rising national debt, what they rarely explain is that this debt is woven into the structure of global finance. It circulates, it stabilizes portfolios, it underpins currencies. It acts as a store of value for institutions that manage trillions on behalf of ordinary people. Which means the real question isn't simply, why is everyone in debt? The real question is, who really owns it? And once we understand that, we start to see how power actually moves through the global economy. Because debt isn't just about money. It's about who holds the promises and who controls the system built around them. Welcome to Empire Economics, where we don't just look at the numbers, we look at the structure behind them. So now we know that government debt isn't floating in empty space. It's held by investors, institutions, sometimes other nations. But here's the part that surprises most people. A large portion of a country's debt is actually owed to itself. Take a country like the United States, or Japan, or the United Kingdom. While headlines often focus on how much they owe to foreign powers, the majority of their government bonds are held domestically. That means pension funds inside the country hold them. Local banks hold them. Insurance companies hold them. Even the country's own central bank often holds massive quantities of government bonds. Which means, in a strange way, the government is paying interest to its own financial system. When a treasury makes an interest payment on a bond, that money doesn't disappear overseas in most cases. It flows into retirement accounts. It supports insurance liabilities. It strengthens bank balance sheets. It circulates internally. So when people say the country is drowning in debt, what they often don't realize is that much of that debt represents savings inside the same economy. Now, of course, not all of it stays at home. Some countries do hold large amounts of each other's debt. For example, major exporting nations often accumulate foreign government bonds as part of managing their currency reserves. Central banks buy foreign debt to stabilize exchange rates. Sovereign wealth funds invest abroad to diversify risk. So yes, countries can owe each other. But even then, it's not a simple creditor versus debtor story. Because those foreign holdings are usually strategic, they're tools of monetary management, not just loans in the traditional sense. A country might hold another nation's bonds to maintain trade competitiveness, manage liquidity, or preserve financial stability. Debt, in that sense, becomes part of a diplomatic and monetary balancing act. And then there's the central bank. This is where the system becomes even more layered. In many modern economies, central banks purchase government bonds directly or indirectly through open market operations. When they do, they're essentially creating money to buy government debt. That debt then sits on the central bank's balance sheet. So the government owes money to an institution that is part of the same state structure. Which raises an even deeper question. If a country's central bank holds a significant portion of its debt, and the government pays interest to that central bank, and the central bank returns profits back to the treasury, what does owing really mean in that context? This is why sovereign debt is different from personal debt. It exists inside a system where money creation, taxation, and monetary policy are intertwined. Governments can refinance it, roll it over, expand it, manage it over decades. They don't face the same constraints an individual does. And yet, despite this complexity, the global debt system is not harmless. Because while countries may owe much of their debt to themselves, confidence still matters. Investors still expect repayment. Markets still react when trust erodes. Debt is stable until belief starts to crack. And in the next section, we'll explore what happens when that belief falters, and why the true risk of global debt isn't the size of the number, it's the stability of the system holding it together. So what actually happens if the system holding all this debt together starts to shake? Because as stable as sovereign debt appears, it ultimately runs on confidence. Investors buy government bonds because they believe the government will repay them. That belief is built on taxation power, economic strength, political stability, and monetary control. As long as those pillars hold, debt rolls forward almost effortlessly. Old bonds mature, new bonds are issued, the machine continues. But when doubt creeps in, everything changes. If investors begin to question whether a country can manage its finances, they demand higher interest rates to compensate for the perceived risk. That makes borrowing more expensive. Higher borrowing costs increase deficits. Larger deficits create more doubt. And that's how debt spirals begin. We've seen this pattern before in smaller economies. When confidence collapses, investors sell bonds. Bond prices fall. Yields spike. Governments are forced to implement austerity measures, raise taxes, cut spending, or seek external support. Not because the number itself suddenly became unbearable, but because belief broke. For large, economically dominant countries, the dynamics are different. Nations that issue debt in their own currency and control that currency have more flexibility. They can expand the money supply. They can purchase their own bonds through central banks. They can stretch timelines. But even they are not immune to market psychology. Because sovereign debt isn't just math, it's trust. And trust can't be printed. So when we ask, who really owns the world's debt? The answer is layered. Pension funds own it. Banks own it. Foreign governments own it. Central banks own it. In many ways, ordinary citizens own it indirectly through their retirement systems. Which means the global debt structure is less like a simple chain of borrowers and lenders, and more like an interconnected web. Everyone is tied into it. Governments borrow. Institutions invest. Central banks stabilize. Markets price risk. And as long as confidence circulates through the system, the web holds. But if confidence fractures, the consequences move fast. Debt, then, isn't just a liability. It's a reflection of how modern economies organize trust, savings, and power. And when you look at it that way, the real story isn't about how much is owed. It's about who believes the system will endure. This is what we explore here at Empire Economics. Not just the numbers, but the structures that hold empires together.